welcome to tonight's webinar, Take 3, the Real Estate Millionaire Mentorship Program 2020. And I'm really excited about this program because it's the clients that are already in the program are getting amazing results. We've got people that are buying the second, third, fourth, fifth property, and some people are doing 4 or 5 properties in the first 12 months, which is quite incredible. So I'm going to share this information with you tonight. And before I go on, bit of a personal disclaimer and a company disclaimer. There's no guarantees in life about anything. You've got to put hard work into anything in order to make it work. And the only person that's going to make you wealthy is you. Also, my personal disclaimer is my results aren't typical. I'm not going to insult your intelligence to imply, but anyway, it means that you're going to become a multi-millionaire by listening to tonight's webinar. Or if you implement anything that I've done with my clients, you're going to make any money at all, because there are no guarantees in life. But the guarantees I can give you is that if you don't do anything, you're going to end up dead broke at 65 with no options. That's absolutely 100% guaranteed, and I'm happy to put that in writing for you. Now, on tonight's webinar, I'm going to cover the Real Estate Millionaire Mentorship Program. But before I do that, I want to give you a bit of an update on where we are in the property cycle and the property market currently in Melbourne. As you know, I'm a Melbourne specialist when it comes to property. So I'm definitely going to be covering all that information with you as well. Now, someone is saying here they cannot hear me. Can you guys hear me? If you can say yes. Perfect. There are some people that are probably having mic difficulties. Exactly what the program involves, I want to break it down into exactly what the outcomes are, what it involves from the mentoring perspective, what are the outcomes, what are the typical things you can hope to achieve with the program, and also who qualifies for the program. It's a very specific program. It's not going to be relevant for a lot of people because it only does a very specific thing. So I want to make sure that you guys have clarity about exactly what it is. And I'm going to come up with some things that it doesn't involve as well, because for some of you, this program won't work, or it won't be something that you're looking at this point in time. You might not be ready, or you might want to do other things with property. There are literally hundreds of different strategies when it comes to property investing. So I'm definitely going to be covering this in detail, and also what the cost or investment is in the program as well. Before we get started and talk about the program, I want to give you a bit of a recap of exactly where we are currently in the property market in terms of the property cycle in 2020, because it's a very exciting time in Melbourne and Sydney at the moment. And if you look at 2019, by the way, we were supposed to have a big crash in 2019. If you remember Armageddon, that story on 60 Minutes, brick and slaughter, as they called it. There's going to be blood flowing on the streets, apparently, in Melbourne and Sydney. There's people who were supposed to be losing 40 to 60% of the value of the properties, and that was just the beginning, they said. It was just the beginning. And they told you to sell your property right now before it's too late, before it's devalued completely to zero. I guess. I'm not sure what happens during a bubble bursting. We've never had one since 1890, so I'm not sure what happens, but I'm assuming the bubble bursts and your house becomes value zero. Basically, you can't sell it, can't borrow against it, it's worth nothing. Now, of course, it's all fairy tale stuff. The market didn't crash last year. In fact, we had a very strong quarter last year, and just for the last quarter last year in 2019, Melbourne did 6.1%. And Sydney did 6.2%. We finished up for the year as a median price in Melbourne 8.7%, and also in Sydney at 8.9%. Now remember, Melbourne has 450 suburbs roughly, so the median price doesn't have a lot of bearing anymore what's happening in the market. Same with Sydney, we have extreme fragmentation of suburbs. Suburbs have a disparity in terms of price points, and the quality of suburbs are changing drastically. We have in Melbourne suburbs that have crime, that have gangs, and we have suburbs that just keep going up in value, and people living there, and they're wealthy and they're very happy, and nothing's happening. And we've got suburbs in between. So you've got to find the suburbs that are doing the right thing for you to make money, because ultimately Houses are not designed to go up in value. They are just designed to house people. As investors, we look for clues of why certain properties go up in value and why others don't go up in value. So Melbourne median price last year was 666,000, and in Sydney it's 840. But reality is you can't get a house in Melbourne for 650. It doesn't exist. Really, in Melbourne, to get a normal house, you need 1.5 million, and to get a trophy house, you need 2.5 to 3. 660,000 is not even house and land packages anymore. But anyway, these are the stats. It gives you kind of a bearing on the pulse of the market more than anything else, rather than actual representation of what's happening in the market, I guess. In terms of the last 12 months, you can see there Melbourne has gone up by 5.3%. This is from RP Data CoreLogic. In terms of housing appreciation, and Sydney has gone up by 5.3% if you take away inflation. For the last 10 years, if you take away inflation, Melbourne has gone up by 53.5% and Sydney has gone up by 66.7%. If you add inflation into the equation, the figure is actually virtually double. Look at Brisbane, guys, 8.5% for 10 years. That's right, for 10 years, 8.5%. So it's stagnating massively, and everyone is betting that the Brisbane will have a big run this year, and I don't believe it will at all. I think it's going to completely underperform. And I'm going to do another video on the webinar, talk about why I believe that Brisbane just won't boom like everyone is expecting it. Well, not everyone's expecting it. Some people agree with me, others have a different opinion. But hey, that's what makes the world go around, different opinions. Anyway, Melbourne and Sydney have record growth because we have record migration coming into the city, with Melbourne having 97,000 people migrate to Melbourne. We've got booming job industry, especially the banking, financial services sector, and the medical sector, and the biotech sector, which is really where all the money is. And on top of that, we have just a really good livable city where people just want to live, and it's attracting high caliber people from all around the world. In terms of Melbourne auction clearance rates, December is not a good indicator of what's happening in the market, because really, if you're a good agent, you would tell people not to sell their property in December and kind of defer their sale into February. So really, the real estate market in Melbourne and really in Australia only operates 10 months of the year. No one wants to do any contracts in December and January. By the time we hit 1st of December, we're in Christmas mode, we're in shopping mode, we're on holiday mode. And then by the time we get back to work in mid-January, we're just kind of not into signing contracts and getting finance approvals. Unless you're a property investor and you're doing it full-time like I am. But really, just to give you an indicator of how strong the market was at the end of last year, and this is Melbourne broken down into sub-regions. And you can see there's different sub-regions. There's the inner city Melbourne, there's inner east, inner south, northeast, northwest, outer east, southeast, west, and Mornington Peninsula. Mornington Peninsula isn't really part of Melbourne. I mean, it's technically... It's included because it is an important slice of Melbourne in terms of the value that it represents, but really you can take that out of the equation and then you've got 8 distinctive markets there. But if you look at the closing rate, we're around, especially the southeast and the inner east and the inner south, you're looking at 78%, which is very strong. That's out of 10 houses, 8 are getting sold, 2 getting passed in. Now, one thing you got to bear in mind is that agents won't always declare auctions where the property was passed in, because traditional agents, real estate agents, want to make the market look better than it is, because it favors their job and their selling conditions. So, a lot of times auctions get passed in and they don't get reported as auctions, they just get cancelled. Or sometimes when the property gets sold after the auction or the next day, it gets reported as an auction that's sold at auction as well. But anyway, this is a really good indicator of the polls. Look, 8 out of 10 properties sold, irrespective of how they are sold, is a very strong market. Having said that, the volume of stock was very low last year, especially in the top 50 or 100 suburbs in Melbourne, in terms of the highest growth areas, which they're all located in the east and the Bayside, because people weren't prepared to sell the house at a slight premium. They were just going to wait and to get a really strong indicator the market's recovered and it's going into the next phase. Hence, a lot of people pull the properties off the market, and that's why last year you had suburbs like Armidale, McKinnon, where there was like 6 houses on the market, East Melbourne, Port Melbourne, Albert Park, 5, 6, 7 houses, Middle Park, so these iconic suburbs virtually have no houses on the market. So when they do come up on the market, people pay a premium for these areas. If you look at Heron Todd White National Property Clock, you can see that Melbourne has moved to 7 o'clock recovery, state of recovery, which is Melbourne. So we've kind of we were at the bottom of the market last year, and then we've moved down from 6 to around 8 o'clock, I would say, between kind of 7 and 8 really, going up to rising market. Now, when we hit 9 o'clock, guys, it's going to get crazy. You're going to get growth of 12, 15%, depending on which area you've bought your property in. That is not a good time to buy a property. That's a good time to already have property in your portfolio, because then, whatever you have is just going to, you're paying a premium. And the question is always asked is when's the best time to buy property? The best time to buy property is at 3 o'clock in the declining market. That's the best time to buy property in terms of timing, if you can really time the market. In terms of reality of the situation, especially for those who are entering the market for the first time, it's a redundant question. It's like saying, when's the best time to go to the gym? Well, the sooner you get there, the quicker you're going to get results. Whether you maximize your time or not, initially, you just want to go to the gym as soon as you can. And, so 3 o'clock is the best time to buy property, especially 4 o'clock and 5 o'clock. That's where all the discounts are, all the rebates. Now there's no rebates. You can't get anything now. The market is hot. Developers won't do anything. So forget about any kind of rebates, discounts, vendor finance. So that YouTube video that I did on 5 ways to buy property with no money down, that's all 3 o'clock, guys. 2 o'clock and 3 o'clock. That's when the market's very low, and the market's depressed, the sales are not moving. That market has moved on now. And it's not coming back for another 4 or 5 years. So even if you do time the market again, you're going to be paying probably 50 to 100% more for properties than we are looking at today. So the thing is, if you haven't bought property before, don't wait for the next time the clock goes around the property cycle. You might as well just get started as soon as possible. So it's not a bad time to buy at the moment, but it's getting to the peak very shortly. So you either want to get in very quickly and really make your selection carefully as well. But like I said, the best time to buy property is when the market's depressed. If you look at June 2019, that was the bottom of the market. And this is dwelling values in Melbourne have fallen by 0.6% over the 3 months to June 2019. And they are 9.2% lower than the past year. So we went back by 9.2%. Values in Melbourne are currently 10.9% lower than the peak in November 2017. So you can see that November 2010 was the peak. It went down by 10%. And now it's coming up. Now, where we are currently, because I know there's a whole segment of you that want to really time the market well, this is where we are. So we've already recovered, and we're currently 3.7% lower than the November peak. Now, remember, there's 8 markets in Melbourne. They're all very different. But if you group them all together, we've kind of passed the bottom already. So for those of you who are obsessed with timing the market, it was last year. It's already moved on. Not only has it moved on, all those properties have sold. Developers and vendors are already increasing the prices of properties compared to those that were sold in June last year, for example. So the same townhouses that were sold June last year are now 50 to 100 grand more. Why? Because they can sell them and they want to maximize profitability. So for those of you who, especially the engineering people that are listening to this webinar who are obsessed with timing the market's already moved on. So you have to, if you don't get in now, you're going to wait for the whole thing to start again, which is about 5, 6, 7 years. And by that stage, whatever you're going to buy is going to be 50 to 100% dearer. 50 in the worst suburb in Melbourne, which is Melton, for capital growth, right? 50% dearer to 100% plus dearer if you're looking at the top 10 suburbs in Melbourne, which I'll show you what they are in a second. One of the biggest indicators, and I'm going to do another webinar on this just on the property market. This is just a quick summary just to give you a bit of an understanding of where we are, because really timing is of the essence right now. One of the biggest indicators that I look for in terms of property cycle is lending approvals and finance applications, because with investors especially, which is the red line, people go in hard and they start getting pre-approved. So they get a loan approval and they get a borrowing capacity assessment before they buy property. And you can see the red line, we were down at the bottom in mid last year, and now we've really come up to so a lot of people are getting loan applications and loan approvals because they are coming back in the market in a strong way. So investment lending is up 30% from the bottom of last year, and investment lending is increasing. So people are going to come back strong this year, and also upgraders, people that already have a house, let's say with 1.2, 1.5, they'll be selling that property and buying one for 2 million, 2.2 million. So the upgraders are coming back as well as investors. The biggest indicator, which is the most important indicator, and this is really the pulse of the whole market, is the red line. The red line represents the upper quartile of properties. So if you divide properties by price point in Melbourne, and this is combined capital cities, this is everything. So if you divide them, and so I reckon the lower quartile will be the cheapest properties from, I don't know, 150,000 to 250. Middle market will be 400 to 700, 800, 900, and it really varies. I mean, you got places like, Tassie, and then you got Sydney. I mean, the variation and the variance between prices and suburbs is extreme. Upper quartile would be your high-end properties, your mansions. In Melbourne, you'd be looking at probably 2.25 million plus. I mean, in Sydney, you're probably looking at 3 million plus. In Adelaide, it's probably half of that. So what happens is the wealthiest people in the market don't need to sell; they choose when to sell, because the properties are unencumbered. They've paid off their properties, there's no mortgage. So if they're not getting the right price for a house, they've got no pressure to offload it unless something really is changing in their life. They're going overseas or the business is really bad. But most of the time, the best suburbs in Australia, there is no mortgages in those suburbs. The houses are completely paid off and unencumbered. So they really choose when to sell. If they can't get the price, they just pull the property off the market. Now, they are back in a big way. And those increases in listings and sales are going through the roof. So in Melbourne, we know it's the beginning of the next property cycle growth, because Toorak and Brighton and all those upper end suburbs, which started the property cycle last time in 2006, those people are back in the market listing their properties and starting to list them. So this is 2006, for example. You can see Brighton, Toorak, Canterbury, East Melbourne. They started the last property cycle, and these are areas that hit $1 million in median price, which is not much now. And obviously, there's a spillover effect between surrounding suburbs. And then we got 2010, 2011, 2012. So you can see how it's kind of growing in the eastern part of Melbourne, the Bayside. You got Sandringham and places like that, Balmoral. And then at the top, you got Eaglemont, and obviously Parkville and Port Melbourne. And then 2016, everything's booming. 2017 was the peak of the market, and then the market went backwards because you can't go indefinitely. You can't just keep going. So in 2000, and remember, there's 8 distinctive markets, but if you look at what happened in 2017, you can see the market contracted, so it went back a little bit by 10%. Now, the media will only focus on the negative aspect of the market, and they'll say the Melbourne property market's dropped by 10%. And, then you get all the Americans on the bandwagon, plus locals, your Harry Dent and your Stephen Virch and all the different skeptics and all the different, I don't know what to call them. I mean, there are a bunch of academics. Some of them are just people that made money in the stock market, and now they think they're fortune tellers in the real estate market. A lot of them have been prophesizing the market's going to crash here, and they kind of resurface every time the market contracts, which it always does around the bottom of the property cycle. So the media jumps on the bandwagon and says, oh, this is Armageddon, it's blood on the streets, property market's going to crash. The problem is that it only goes back by 10% or 12% and then keeps going again. It's like saying, you've got a 911 turbo Porsche going 300 k's an hour, and then you slow down by 10%. Well, you're still doing 270 k's an hour. So people that have bought properties in 2008 made a lot of money. I mean, I settled the property in 2008 in Vermont for $650,000, and it's worth now about $1.65 million. I made $1 million on this house an investment property that I own in Vermont on a 1,330 square meter block. Now, yes, if I were to sell that property last year, I probably could, instead of 1.65, I probably would have got 1.55. I'd still be really happy, guys. It's still 900,000, you know? So the media already focuses on a small part of the market, which is the negative part of the market. They don't do stories about positive parts where people are making money, because that's the story, you know? As they say, bad news sells. So and now we forward in Sydney. I mean, Sydney is just a version of Melbourne with it more extreme in price and more fragmentation in price. So in Sydney, there are suburbs that are just extraordinary. You know, they make Toorak look cheap. And there are suburbs that are really cheap and they're going nowhere. Let's talk about the real estate mentoring program, because it's really now, for those of you who wanted to get into the market for a long time and you weren't sure how to get into the market, and you might fit into one of the following three categories. This is really what this mentoring program is about. And I can tell you now, I've got over 100 clients in this mentoring program, and I'm going to tell you why I'm offering another 10 spots in the program in a second, which has to do with the banking inquiry that occurred. But really, there's three types of people in my program. Number one, I've got a lot of doctors, dentists, high-end, white-collar professionals on high incomes who are very smart academically and in their job. They're specialists, but they just never had the time to really put in to educate themselves about property, and they're time poor. They're running a business and they really don't want to go out there on weekends looking at real estate and make offers, because they'd rather spend their time with their family. So those people use the program in a way for me just to basically choose the right properties, give them advice around lending, and package up the whole thing to make it super simple for them. Otherwise, they'd be paying tax. So going back, as I was saying, there are three groups in my program. The number one group is your professional, your doctor, your dentist, who's time poor. They're super smart, a lot of money, paying a lot of tax as well, but they're just too busy to really start investing in real estate. They just don't have the time or the inclination to spend their weekends researching real estate, making offers, and building their wealth that way. And they know they have to build their wealth because they're working huge hours and they're paying a lot of tax. If they don't start building and accumulate assets, they got to retire on very little money. So I've got a lot of clients who are lawyers, doctors, dentists, and medical specialists. Time poor, very smart individuals. And they're very active, very easy to deal with, and a lot of them are buying 3-4 properties in the first 12 months. The second group is people that are paralyzed due to over-analyzing the market. They're actually too smart for their own good. These are mathematicians, engineering people. They've been looking at the market for 10 years. They've even bought sometimes in the wrong area, holiday type of dwellings or properties where they're going to renovate the property. They've ended up getting renovated. And really, they haven't got any results in the last 10 years. And some of them have never taken action because they just keep reading RP data reports and playing around with Excel spreadsheets, and they just get so overwhelmed with the data, they just can't move forwards. And because they're working in the engineering job 60, 80 hours a week, they just haven't got the time to do the proper analysis and due diligence required. So I've got that sector as well. These are very kind of introverted, high-level analyticals who are in very technical backgrounds, and usually it's IT engineering, account, and I'm working with those. They understand numbers. It's such an easy conversation because once we get through and feel through white noise, it's not relevant. They didn't get it. They start investing and building their wealth. The third, people kind of either haven't got the skills, don't really want to get educated. They're just enjoying life. They don't really want to read books or go to web, and boot camps and years educating themselves. They know they need to invest because they pay tax, and they're police officers, teachers, post takers. I've got people from all different walks of life, business owners, self-employed people, but they've got this urgency. They've got an understanding that they need to end up with 1 or 2 or 3 properties at retirement. Otherwise, they're going to be on the pension. But they haven't got, sometimes it's just you haven't the confidence, I guess, to make a decision between properties. You don't know what to look for. So they're the ones that I work with as well. And Stephen McClutchy and myself, we put together a program for them, and they get into property and they can see, really good results. The program is not for people that want to do property development or subdivisions or anything like that. Definitely those people cannot be in the program. And obviously, because the foreign lending has been shut down virtually completely in Australia, anyone that's deriving an income overseas, it is very difficult to get a loan because of the recent banking changes as well. So I just want to let you know, a lot of clients overseas that follow me, it is very difficult to get lending if you're deriving an income overseas unless you want to bring it back into Australia, which sometimes is not really that relevant. The key thing about life, guys, is you've got to be really comfortable. You've got to have a sense of fulfillment in terms of what you want to achieve. Because if you plan on being anything less capable of being, you'll probably be unhappy for all the days of your life. It's very true. And the hardest thing about investing now is getting started. Getting started is the hardest thing. Your first property is the hardest thing, and getting your structure set up correctly, buying your first property so you get a lot of equity, and then going again. Once a good experience with your first property, chances are you're going to get second, third. If you have that experience with your first property, you'll never go back into the market again. This is where I see people buying properties in the Gold Coast or buying apartments in Dockland, South Bank, in Melbourne, or Hassel Land Estates in Point Tunley, Berwick, and them. There's nothing wrong with those areas. They're just growth, and you can't build a portfolio if your property is growing at 3%. You'll never get equity out. You're going to be 9 before you have 5 properties. The idea is you want to go quickly as you can. So why is it that so few people succeed in real estate investing? Most people, 72% of all investors only have one property. 0.9% have 6 or more. And if you've been following my YouTube channel and my live events, I've been a number these people that have more than 6 properties, and really people that have 10 properties plus. They're the ones that I've been focusing my attention on. And it's interesting because a lot of it has to do with psychology and mindset. Not very little has to do with their income that they're earning. But most people, the reality is they just don't have a strategy. Most people have a buy, hold, and pray to God investment strategy. There's no plan there. There is no structure to the plan. They just buy something, sit on it, get an interest-only loan, and hope they can go again. What we do in the program, we do an all-encompassing investment plan, so you know your outcome from day one. You know what your goal is. It's either an equity goal. I want to build up a portfolio worth $6 million with $4 million net equity, or I want to build up a property portfolio that gives me 120,000 passive income per year net after all expenses. So you've got to write down your objective, and then you have to re-engineer that back into property acquisition. That's really what the program is all about. And I can tell you in Melbourne, if you look at the 390 suburbs that officially make up Melbourne, there's actually more suburbs than that. There's about 60 suburbs in Melbourne that are brand new that no one cares about because they're 60, 70 k's from Melbourne and you can't get there. But anyway, out of 390 suburbs, 198 have doubled in median price to June 2016, which was just below the last peak. But 192 haven't doubled in median price. So just because you're investing in Melbourne, it doesn't guarantee you're going to make money. Same with apartments, they're even worse. Out of 270 suburbs in Melbourne, we can build apartments. 222 haven't doubled in 10 years. Only 48 suburbs that have apartments in Melbourne have doubled in the last 10 years. And now apartments are a disaster in Melbourne. I mean, not even the best suburbs are growing in value because of all the issues with valuations, cladding, and all the structural problems that have come out from Sydney. And there's probably going to be a big inquiry into the building sector. So a lot of people are really hesitant to get into the property market and buy apartments. The trouble is, as Buddha said, you think time. And this is the problem with investing. People just wait for this perfect time in their life when they can start investing in property. But I can tell you most of the time, you got to ask yourself, what if this is as good as it gets? What if there's always going to be stuff happening in your life? You got to make the time and block the time and just commit to a plan. I mean, it is hard. It's not easy. If it's easy, everyone with large property portfolios, everyone will have massive passive income, and they'll be the reality is this is not an easy thing. It is simple to do. You follow a process once you know what it is. It's not easy. It is, I can tell you guys. Here's $1 million question. How do I level this? Well, the way you level is effective education combined with professional over a reasonable period of time. You've got to get educated. you've got to have professional mentoring over a reasonable period of time. Now, the difference between a coach and a mentor is very important to understand. The difference is profound. I think here that audio is very broke. Is that correct, guys? Can you still hear me? It's coming in and out, is it? Okay. I'm going to have to update my laptop. So, effective education with professional mentoring over a reasonable period of time. I'm going to send you guys this webinar. I'm going to do another one next week because poor quality audio. Okay. So I'm going to get new equipment, another one, because it's obviously affecting things on what it is. But a coach is someone that you to do things that educate you. Mentor is someone that basically tells you what to do exactly because they've done it themselves. So coaching is a lot of coaches, life coaches, a lot of coaches out there motivate you to kind of point you in the right direction. That's what a mentor does. A mentor actually tells you this is what you need to do. Copy that you need to buy, the line of credit you need to get. This is the need to go CBA, get the package with regional line of credit, set it up to AEDs to that, go to the financial plan, get this done, that done. It's literally either step-by-step instructions of how an outcome. It's not about educating, it's about getting its outcome performance-based program. So it's a little bit different than coaching. Coaching about inspiring guys. Now, as you know, you probably read all of my books with Australian Property Finance Made Simple, which came out 5 now, which is incredible. Time flies. The second book I've just completed now is Australian Property Investing Made Simple, which is coming out this year, definitely. And then due diligence research, which I've also done 30,000 with that book. And the final one that will come out, I'm also thinking of doing more psychology with a couple of the authors that I've met. Co-author a book about property psychology and mindset. This will probably this. The final one will be the real estate and mental book, where I'm basically going to monitor the journey of 100 people I've taken onto a 5-year journey and document exactly what they did over the 5 years and what results they are. So it's the first 3 books, 4 books will be purely theory. There won't be any case study in there. Will be people who have actually implemented every in the first 3 or 4 books, and these are the results they have. Now the key thing is you have to use my accountant and my solicitor because you're going to be audited. If you end up in the book, there's going to be 30 cases in the book of the 100 people in 30 chapters. So I'm going to choose different walks of life with different results. But really, at the end of the day, the key thing is a great book with examples that people can relate to in the industry. So if you're working in IT or if you're working in accounting, you can read a couple of other accountants that have done the portfolio, see exactly what they did, where they purchased, how much, what product they used, what the results were, valuations were, how much equity they got of the property. And this they have to use my same team because if you audit, the accountant will say, yes, I've settled I've done terms of this client, and the law say, yes, we've settled all this for this person. It's bullshit that Jenny hasn't bought properties and she's a teacher. It's possible. Well, she did, and he's an accountant that swear and verify she did it because doing a tax. Obviously, she had obviously she sold those properties as well. So that book is going to be out this year. It's just finished now, and I'm just getting through the auditing stages. And out eventually book well. Originally, I focused on getting 100 people into the program, and we got 100 people. The program started mentioning the problem arose where banking regulations have changed. Some people on low income have purchased 3 or 4 properties, depending on, and now with they wouldn't buy any more, be completely maxed out. And I've got people on 70 grand with properties, 700-800 each. Now, technically, you shouldn't have those properties in the current system. So it's got the mean for the system change, which I've covered what happens and how the system has changed, and so the criteria change permanently, and no doc lines are disappeared. But they're happy, by the way, because they have maxed out their resources in their situation, so they're not earning. It's just freed up myself to take on more clients. So I've decided to take on 10 more clients in 2025 years. So there are 5 positions open. In the program is basically a fast track your journey from A to B and build a large property portfolio team and give you a whole team plan, set the properties with you, control, make it very simple. Designed for you to give the results. So imagine running a gym. You can run a gym and do whatever you want, or you can get a personal program for you and stick with you throughout every training, tell you what to do, how many reps to do, and you don't have to think. You just do exactly what they tell you, and you're going to get massive results. Yes, you will be learning. It's not about teaching, it's about teaching. So this is not a program about education, guys. It's about results. It is guaranteed. Initially, what happened in the program is spend about 3 hours doing once you qualify, which I'll cover in a second, a 3-hour in session with me, and I need to understand exactly where you currently are, and what you want to accomplish, and what strategies we need to implement in order to bridge the gaps between where you are and your financial objectives. Then you get a pre-approval from a mortgage broker, which is Loans Australia. Then you choose you can a whole day with me in my car. We drive around Melbourne, looking at the bus in Melbourne, and we choose a property. And then you go to the accountants, the structure. You get the whole team. Really, you get the financial planner, the mortgage broker, the bankers, the solicitors, right down to quantity surveyors, which is BMT, property manager, insurance specialist, everything. It's a holistic solution for your whole plan, for your whole life, including a financial plan by Fortune Financial Planning. What properties will be shown in the mentoring program? This Prime Real Estate is the company I run. Very unique in that we properties top 45 best subs in Melbourne. So I'm a sourcing specialist. I have access to over 4,000 properties at any one time, but I only do about 75 to 100 transactions in a year. So I cherry pick for the best suburbs and the best projects in those suburbs for my clients. So we do through Investors Prime Real Estate and negotiate special deals, from time to time. I've managed to get rebates, discounts on developers. If you see my YouTube videos, like at the bottom of the last property cycle, in Footscray, for example, which I'll show development, the developer was offering 10% cash back on your deposit. So you pay a $70,000 deposit. At settlement, you get $75,000 in cash back. Why would he do that? Because he wanted the sales and he couldn't discount the actual apartments or townhouses by $75,000 because he would drag down the valuations for the others. But he wanted to move more stock, which is exactly what he achieved. The most important thing about this is that I'm an investor, guys. I'm not a real estate agent per se. I've never sold mum and dad houses. So I'm a real estate agent because legally I can't sell property without it. I can't handle a contract of sale in Victoria. It's illegal. You're in breach of the sale of land. But I'm an investor myself. I'm not an real estate agent. I never wanted to become a real estate agent. I had to do it. And also I offer unbiased education and property sourcing. Townhouse start from $685, and really you need about $800 to $9,000 for a good 2-bedroom townhouse in Melbourne. Yes, they've got a lot. There's no such thing as a cheap, high-performing property guy. They're expensive, perform well. Like they townhouses years ago were $650, now $1.2 million. They've doubled in 6 years. The areas that I focus on are these areas here, the highest growth areas in Australia for the last 10 years. which is quite interesting. So if you look at, you know, they're all pretty much in the eastern suburbs. And if you look at Mount Albert, this is the highest performing areas. They've grown by 11.8%. Baldwin North, Middle Park, Mount Albert North, Ashburton, Baldwin, Glen Waverley, Doncaster, Mount Waverley, St Kilda West, Box Hill South, Dippendy, Camberwell, Blackburn, Surrey Hills, Box Hill North, McKinnon, Belwood East, Canterbury, Ashwood. These are areas where they've gone up by 10% per year on average, you know, between 9.4 and 11.8. They double every 7 years on average. And I go down, there's about 25 other suburbs that I go down the list. They're all pretty much in the Bayside and the eastern suburbs. There's an example of a development in Hawthorne Street, Balaclava, that I currently have, which is 26 townhouses. Balaclava will be the #1, mark my words, growth area for 2020 in Melbourne. I think it will grow by about 16 to 20%. And it's been identified by independent other bodies as the #1 growth area in Melbourne. Two bedders here are ranged from 855 to 955. The project is off the plan, due to complete next year, and they just started construction now. So these are architecturally designed properties, one of the fastest growing areas. Now, if you don't know Balaclava, it's virtually St Kilda in Melbourne. This is architecturally designed with rooftop terraces. On the beach, very good area, lots of cafes, restaurants, really close to the city, great area to live in. I grew up in St Kilda, I went to school there. I know the area back to front. It's one of the most iconic areas in Melbourne. I get the equivalent in Sydney would be like Bondi. It's just a really cool, trendy area. This is a development in Parkville, where townhouses are selling for 1.345 to 1.37. Really good development, just completed, so they're 100% completed. So I've got stock that's 100% completed, brand new, or stock that's up and coming. And once again, this is like a couple of k's from the city, near the biggest hospital precinct in Australia. We have a lot of medical specialists and doctors just around the corner in 3 major hospitals, which is the Royal Children's Hospital, the Alfred Hospital, and the Women's Hospital. There's Parkville there, there's a city, great area. Majority of Parkville is actually parkland. So these are the kind of properties that I source in my mentoring program for my clients. 3 levels plus a rooftop terrace. Parkville, by the way, if you look at capital growth from 2012 to 2017, the median price in Parkville went up from 720,000 to 1.71 million. So they went up by 138.5%. Houses went up by $1 million in the suburb. So these are some of the areas that I've been sourcing in for the last 5 years, or since 2012. It's 8 years now, actually. But I say to 2017 because that was the last peak of the market. So South Yarra, Huntingdale, South Melbourne, Flinders, Box Hill, St Kilda West, Ashwood, Ashburton, Box Hill North, Blackburn South, Mount Albert North, Fitzroy, Oakley East, Carlton, Alphington, Doncaster East, Clayton, Blackburn, and Prahran. They virtually doubled, 90% growth, you know, incredible. Obviously from 2017, which was the peak, they went down by 10%, but it's a paper loss. You never sell these properties, guys. You just keep buying, refinancing, and keep buying more properties. Buy, hoard, never sell, they're saying. This is in Footscray, which is a development. They've just started construction on 2 and 3 bedrooms. 3 bedders are going for around 750. Architecturally designed. Footscray West, great area, you know, one of the top suburbs in Melbourne for growth. And these are really well designed properties. Once again, 3 levels, 3 bedrooms, open plan living, courtyard, and the rooftop terrace. These are the ones with developers giving rebates at the bottom of the cycle. Now there are no rebates on this project. This is a great property in Bentley in Vickery Street, 100% completed. There was about 6 left in this project. Never been lived in the McKinnon High catchment area. So McKinnon is one of the best public schools in Melbourne. This is in the catchment area. And these are 870 to 950, 2 bedrooms. There was only 10 townhouses in this project. Bentley is a great beachside suburb next to Brighton East and Brighton. Very good schools, very good shopping, ticks all the boxes, great location, great capital growth. Bentley has grown at 10.9% for the last 10 years, according to RP data. So really good location, really good properties. Once again, architecturally designed. So you have really high level fixtures and fittings, great for depreciation and great for attracting white collar tenants. This is apartments now. Are apartments good in Melbourne? No. Do not buy apartments in Melbourne. It's a disaster. Even in the best suburbs, they don't work at all. Now, if you've read my book, I've got a 3-to-1 criteria or ratio that if you only buy in areas where the house was 3 times the price of a 2-bedroom. So, for example, in Toorak, back then, a detached house is $3 million, an average 2-bed is 672,000. So they do well. They don't do well at all at the moment. Okay, so I wouldn't buy apartments anywhere in Melbourne. There's massive valuation issues. Okay, number one, valuers are very conservative. Number two, because of this whole issue in Sydney with all these structural problems these apartments have, it's going to spill over to Melbourne. So my problem with apartments at the moment is if you buy one and you type all your money in there, can you get all your equity out in 2 or 3 years' time? No, not if there's lending restrictions imposed on apartments. At the moment, there isn't, but there could be in the future. What's the point of risking it? Because you can't sell it if that happens. So I just say just stick to townhouses and detached houses. Don't touch apartments in Melbourne at the moment. It's too risky. House and land is a complete disaster in Melbourne. It doesn't work. They're too far from the city and no one can get to the city from them. Yes, they're beautiful. I love 4-bedroom houses on big blocks. They look wonderful. And it's really cool to live in them. You just can't get back to work or the city. You're in traffic for an hour, swearing all the way. So apartments are no good. Houses in fringe suburbs also don't work in Melbourne. And these are some of the estates. This is 10 years growth, the last property cycle, which peaked in 2017. I mean, look at it. I mean, it's below inflation, guys. You know, if you look at Trigonina, Tarneit, Point Cook, all the ones, Wyndham's Landing, you know, 3.2% growth, which means you'll double in 18 years. I mean, you're going to be waiting forever to get the equity. It's craziness. Yes, you do get more value for your money in terms of bricks and mortar and land, but there's no growth. And the problem is developers are holding 13 years worth of supply in house and land estates in Melbourne. And look at the you know, if you look at the biggest land developers, Pete's, for example, they have 44,000 blocks of land that they're holding currently, and they only sell 2,623 per year. They've got 17 years worth of stock that they can release tomorrow. So the problem with house and land in Melbourne, and these are publicly listed companies, by the way, you can check this information. If you look at FKP, Sunland, Villa World, Mirvac, Australand, Pete, Landlease, Stockland. If you look at all the companies, look how many blocks they're holding on to. So this is why house and land doesn't work, because it's infinite supply and there's no demand from high income demographics. The opposite of that is capital growth, limited supply. I mean, there's no houses in Balaclava. There's like 3 projects. If you go to Balaclava on the realestate.com, put in houses and townhouses, look how many properties are in the market, and then go to Point Cook and put in houses and townhouses, look how many properties in Point Cook. I mean, it's uncomparable. So, you know, this is the problem with these areas. They're great to live in, by the way, and I'm not bagging the areas for lifestyle. I'm just saying for capital growth. And let's be clear on this, because people sometimes think, oh, we live in this area, you don't like the area. I don't like most areas, but it's nothing to do with liking the area, because investing is just to make money. Living somewhere is what you like to live in. So it's got nothing to do with livability and capital growth. They're 2 separate things, guys. Please don't confuse the two. All I'm talking about is making money. And making money where you're going to get the highest growth. And remember, the most important thing about any quest is to get started, which is the hardest. The objective of this particular mentoring program is to get into 10 properties over 10 years as quickly as possible. And it's all done for you. In terms of the structure, the first thing that we do is we have a strategy session with myself and the mortgage broker. We work out your point A, we get you pre-approved financially, and then we sit down, we tell you realistically what you can accomplish in 10 years' time in terms of property acquisition. And this is just a very general, broad look. You can buy 3 properties, 5 properties, 10 properties. I've got clients that are struggling to buy 3 properties or 2, and I've got doctors that are buying 2 or 3 properties per year, and they can do more if they wanted to. I give you the mortgage broker, then I source the properties, you get the accountant, you work out whether you should be buying the property in a trust or your personal name. You can also set up your self-managed super fund with the accountant and the financial planner. I give you the property solicitor to vet your contracts. You get your wills and estate planning done. You get the property. I give you the property manager. They give you landlord's insurance. They manage the property for you, right down to financial planning, income protection. Because remember, the number one resource that you have during your building phase of your property portfolio is your ability to make money. So if you lose your ability to make money, you get injured in your job, everything stops. So, your financial planner is the person that can organize income protection, life insurance, total and permanent disablement, trauma insurance, all these things that can stop you from making money. So it's a one-stop, not a one-stop shop, or one-stop solution of having a financial health check done, having the whole life structured once perfectly, and you don't need to worry about anything. You just keep updating, and reviewing your whole plan. But you've got the whole team there, and you've got a very clear understanding of where you're getting and what the possible outcomes are. The program is $5,000 or $4,997, as it was in 2015 when I started the program. And it's only via a strict application process that you can apply. And I'll tell you what that is in 1 second. There's only 10 people that I'm taking on this year. I'm at capacity, but with 10 people, I can still do 10 people comfortably. But beyond that, I'm not going to do more. You probably don't know this, but I don't work that hard, guys. I only work Monday to Thursday. I have Fridays off every week. I have a long weekend virtually every week, and I take 5 holidays a year. Short ones like 5 days to 7 days, and then over Christmas break I take the whole month. But I actually don't work that hard, and some days I pretty much start at 10 and finish at 4 or 5. So I don't want to work any longer than I have to, and I enjoy what I do, but I don't want to work any more hours. I don't need to. So the program is $4,997 for 5 years of mentoring. It is guaranteed results. If you are interested in applying for the program, just email me, conrad@investorsprime.com.au, and I'll send you the application form together with the brochure. And what I'll actually send you is a couple of things. But before we go there, this is the minimum requirement to apply for the program. You have to be working full-time as an individual. You probably want to be on about 80 grand a year income. So you need to be able to borrow at least 700,000. Ideally, you're on like 95 plus. That's like the minimum, and about 112,000 in equity. So you can borrow instead of a $700,000 townhouse. I mean, there's nothing really that I have that's cheaper than that. I've got some for like $675, but really, there's no point buying anything cheaper like that in Melbourne, because it just means it hasn't gone up in value. You might as well just go to other states. If you're a couple, 60 and 80 combined, and then 112,000 equity. So you can still then service a purchase of about 700,000. If you're borderline, by the way, just drop me an email. We'll get you assessed. So what I'll email you is an application form, which it's a 4-page form, and it gives me an idea of what you want to accomplish, what your outcomes and objectives are. And then also I give you a client's analysis form from Loans Australia. We give you a full financial assessment. So these two things, once I give you these two forms, you just email me back the form, and you email the client information back to Loans Australia and Patterson, which are his details. So you download the application form. It'll be attached to an email. Okay? I'm also going to email you these forms anyway if you're automatically in the next days, if I don't hear from you. And then you get a financial assessment. Once we assess you financially, then we book a 60-minute phone call, or you come to us in Singapore for a coffee for 60 minutes, and it can be a little bit shorter. I'll tell you realistically, this is what we can do based on your current circumstances, based on your income and your equity position. This is how many properties you can buy. This is roughly what your income will look like in 10 years from now. This is how much equity you'll end up with 5 or 10 years based on cumulative age and growth. And this is where you could be in 5 or 10 years from now. And I'll give you a real plan. There's no fee, by the way. There's nothing. There's no strings attached. And then if you're happy with that plan, if you understand it, then you can proceed with the mentoring program. Okay? So up to that point, there's no payment. There's no obligation. It's just basically to see if What's the benefit of Konrad? What do you think reasonable for that I can achieve? So those two forms, you can't fill out these forms, you can't apply for them, okay? Because something in real estate, guys, is a lot of forms, okay? Loan applications, setting up trusts, setting up self-managed fund, financial planning, insurance applications. You're constantly doing forms, okay? So for those who can fill out the form, pages, let me tell you, real estate's not the industry for you because it's a lot of paperwork. Filing cabinet. Once I get the forms back from you, my office will call you. You can set up a time to chat. If you're interstate, with your phone. If you're over, do WhatsApp. And then if you're in Australia, you can get in Melbourne, you can get a coffee in St Kilda. And look, the 60-minute consultation in itself, a lot of people get massive value out of it because I can tell you in 25 years of experience, this is what you can kind of look at and what you can expect if you just conservatively buy property with buffers, refinance in the right area, and keep buying and leveraging off these properties. That's about it. So good luck with the application process. And if you have any questions about the program, anything you like, just email me, conrad@investorsprime.com.au, and I'll answer any question that you may have. And there's only 10 places available based on who applies first, basically, and who gets accepted. So the sooner you apply, the sooner you get all the paperwork back, the sooner you're in the program.